which are perhaps of a medium-term nature, and then I have a trading portfolio which is basically for punting, as I would call it.
And does that mean there's also a difference between short-term investing and long-term investing?
I think very much so. With long-term investing, you're really looking to lock into the capital gains, which will be the product of the growing cash flows and profitability of the economy and specific companies over a long period of time. With shorter term investing, you're really talking about trading, which is really the speculation on price movements, and that could be quite independent of the fortunes of a specific company or a specific or the economy on a fundamental basis.
How important is it to diversify your portfolio?
I would say absolutely vital. If you are starting a portfolio with a relatively small sum of money, maybe between £100 and £1,000, you might actually be better off starting with something like an index tracker fund that will create that diversification for you, because the fund manager will go out and buy 100 different shares in a FTSE tracker. Once you get a little bit more, maybe you have £10,000 or so, you can then afford to go and buy perhaps 10 different shares in 10 different areas, at which point your risk has been reasonably well spread.
So Mark, any personal tips on investment styles?
Most people are fairly well versed in the concept of conventional diversification. First of all, they diversify by asset class. So for instance, they might have some cash, they might have some bonds, they'll probably have some equities, and they might have some overseas equities, which we touched upon earlier, and that is well and good. But there is also a case for what I call technical diversification, which is to try and pick a range of stocks that show different but positive technical characteristics. And there are three main categories here. The first is the breakout category, and these are the super powerful stocks that are pushing to new highs. So at the time of speaking, we'd be looking at stocks, perhaps in the mining sector, some of the utilities. We'd also be looking at selected overseas markets, such as India, which is continuing to show great strength. So that's the first type of category, technical diversification. The second is the consistent uptrend. So you look for a stock that is in an uptrend, possibly pulling back from it, but still holding above, say, its 200-day moving average, or the positive pattern that it will have exhibited over the longer term. And by the longer term, I mean 18 months plus, hopefully 5 years. That is the kind of stock you want to try and buy on the retracement for looking for the reassertion of that underlying strong investor sentiment. And the third type is the base formation, looking for those oversold stocks which have had very sharp declines, but which are now starting to recover. They might have seen a downside acceleration, a final sell-off. They're now trading sideways. They haven't pushed to lower lows. These are the recovery candidates. But if you mix these three types of formations, it's a useful play. You won't be getting sucked into a large amount of overvalued assets. You won't be trapped into the situation, and a lot of investors can do this, of buying a lot of dead ducks that are never going to be bouncing. And you've also got the middle category as well. So it's something I use myself, and I can recommend it.
So we've learned about how the stock market works and the benefits of investing in a portfolio of shares. It's time for the Stocktalk Insight.
The price-earnings ratio is one of the most useful measures of a share's expensiveness. It is calculated by dividing the share price by the earnings per share. It can tell you both that a share is cheap or expensive, or if you're looking at the company from a different perspective, it can tell you the confidence the market has in its growth potential. This is because the PE gives you a multiple of company's earnings. How many years of earnings is reflected in the share price? It's neither good nor bad to have a high or low PE, but it helps you to make a judgment. A low PE might tell you it's cheap, or conversely make you worry that there's a problem with the company. Similarly, a high PE might lead you to dismiss the stock as too expensive or give you confidence in the market's strong valuation. It depends what type of investor you are. Remember to compare like with like. Different sectors will have different multiple norms. The charts are always a good place to start looking at shares. They indicate momentum, trends or sentiment and give buy and sell triggers. Chartists learn to recognise patterns. Simple patterns include trading range breakouts where resistance and support levels are identified. Moving averages are another. By identifying longer-term moving averages, investors may be warned of possible buy signals or golden cross. This is where a rising short-term moving average crosses a rising medium-term moving average. Sell signals or dead cross occur where a falling short-term moving average crosses a falling medium-term average. We will cover technical analysis in a future programme. In the meantime, the technical analysis microsite is available from the research section of the Selftrade site. Shares bought on the stock exchange are said to be on the secondary market. They have been owned before, although their value is not affected by being second-hand. Many investors seek new issues or IPOs, initial public offering, where companies listing for the first time offer their shares to potential new shareholders. Since the number of investors is limited, there can be a demand on the first day of trading. Those who choose to sell quickly are said to have snagged the issue. Others find that getting in at entry level is one of the best ways of building a portfolio and benefit from not paying stamp duty.
Well, that's it for this edition of Stock Talk. I hope you found it useful. If you'd like more information, call customer services who would be happy to help. And if there's any topics you'd like covered by the programme, please email me at the address on the screen. Thank you for watching.